Welcome back to the Deep Dive. Today we are tackling a direct request from you, the listener. We're going deep, taking a really forensic look into an asset that's seen a truly catastrophic price movement, the TLOS token on the base chain. Our mission today is pretty carefully focused. We really need to figure out why this price is consistently falling, not just dipping, but falling. We'll examine the price chart, the actual movement to understand the mechanics behind all that volatility. And crucially, we need to look into whether the team bears responsibility for this mess. And maybe most importantly, check the integrity of this specific token's contract on base. Is it even sound? We're here to dig out the truths hidden under some pretty shocking data.
That really is the core challenge here. Our analysis, it's zeroing in on the period leading up to and including that crisis window between October 1st and November 8th, 2025. And this time frame, it isn't just about, a bit of volatility. It feels more like a systemic failure unfolding.
Right.
We have to look past thinking, oh, just another bad day for the price. We need to see the relentless downward pressure that raises, frankly, serious questions about its basic legitimacy and its future in the market.
Okay, right. Let's unpack this then. We really have to start with the chart because, wow, it paints a picture of long-term weakness that you just can't ignore. For anyone tracking the history of the TLOS token, calling it a bear market just doesn't cut it, does it? The source material we reviewed highlights this severely bearish trend, and it seems to have really accelerated throughout 2025. That suggests, deep problems actively pushing the price down. Let's get specific on the numbers, because they really hit home and show what's at stake. As of early November 2025, the token's trading around, what's 0.032 USD?
That's right, about 3 cents.
3 cents. That's an 86% collapse just since the start of this year, 2025. But then, if you zoom out, the historical context is almost, unbelievable. The all-time high for TLOS, the official one anyway, was the $1.43. That was back in February 2022. So this current 3-cent valuation means it's down a staggering 97.76% from its peak.
97.76%.
Wait, just pause on that.
Yeah.
A 97.76% decline from the all-time high. That sounds like almost total failure, doesn't it? How do investors, especially the ones who held on, even begin to process that kind of loss? What would it even take for the market to believe in a recovery from that deep a hole?
It's truly an existential crisis for the asset, yeah. And the psychological barrier, it's immense. Recovering isn't just about needing some good news. You're talking about needing like 100x growth just to claw back a fraction of where it once was. What's really interesting, though, or maybe alarming, is how October looked relatively calm on the surface, even while masking this deep distress. For most of October 2025, if you just glanced at the daily charts, it seemed kind of sleepy, right? Holding steady in that $1.03 range. But if you looked closer, that stability, it was totally a mirage. The charts were actually full of extreme intraday volatility. We're talking sudden, massive price swings. You see them as these huge candle wicks and big gaps in trading. These aren't signs of a healthy liquid market at all. They're symptoms of really high stress and poor structural health.
When you say large wicks, you mean the price shot way up or way down for a month and snapped right back.
Okay.
What does that visual chaos tell us about who's actually trading this thing?
Exactly that. A large wick means, in a very short time, the price hits some extreme level before snapping back. If the wick's pointing down, it usually means someone got forced to sell at a terrible price because, there just wasn't anyone willing to buy higher ups. If the wick points up, it means a tiny bit of buying could briefly pump the price, only for sellers, maybe profit takers, or just anyone wanting out, to immediately smash it back down. It really indicates that the main players are either forced sellers, liquidations, or super aggressive short-term speculators, not long-term believers. And another critical pattern we saw looking through the data is this consistent failure of recovery attempts. After any big spike like the one we absolutely have to talk about from October 31st, the price doesn't just settle back down. Often it actually uses that event as an excuse to fall even further. It's like the market sees any brief upward movement purely as a chance to sell, not as a sign that things are getting fundamentally better.
Okay, that makes sense. It's seen as an exit opportunity.
Precisely. So if we connect this back to the bigger picture, these violent visual patterns, they are screaming evidence of critically thin liquidity. Think about trying to fill a swimming pool using just a dripping tap. It's kind of like that. In a healthy market, a big buy or sell order gets absorbed pretty smoothly, like pouring water into a full pool. But here, with TLOS on base, even minimal trading volume causes these massive outsized price swings because the order book, the list of buyers and sellers waiting, is practically empty. This lack of depth, that's the core structural reason the price is so erratic and violent. It's a market that just can't handle any real weight or stress.
And man, if you're looking for the poster child for that kind of violent movement, that October 31st flash spike. That's it. It wasn't a slow drift. It was pure market chaos, crammed into a single candle on the chart. The sources detail this incredibly dramatic surge. The price briefly, and I mean briefly, spiked all the way up to 0.1379. That's a mind-blowing 377% jump from where it was sitting.
377%.
Yep.
In moments.
Imagine watching that ticker. Just for a second. Pure euphoria, right? But it lasted, what, seconds? The price immediately crashed straight back down, landing right back in that familiar depressing range of about 0.027 to 0.032 tests. It was like this cruel flash of hope instantly yanked away. It just confirmed there was zero real foundation under that price.
Yeah, and it's really crucial we don't just look at that spike in isolation. It happened alongside significant broader market volatility that had been brewing throughout October 2025. This was triggered by larger macroeconomic stuff, particularly geopolitical tensions. We actually saw an earlier, more systemic shock on October 10th, 2025. That was the day former President Trump announced plans for 100% tariffs on China. Now, you might think, okay, tariffs, what does that have to do with crypto crashing?
But it seems disconnected at first glance.
It all comes down to leverage and margin calls. That geopolitical risk created this wave of uncertainty across all global markets, triggering massive risk-off selling. People just wanted out of risky assets. And because cryptocurrencies, especially altcoins, are so heavily traded using borrowed money margin and leverage, the resulting market drop pushed tons of these leveraged positions below their required maintenance levels. This forced automatic selling, liquidations, across the entire crypto space. The source material we looked at estimates this single event caused something like $19 to $20 billion in total liquidations.
Wow. So a trade policy announcement triggers automated forced selling because prices dropped just enough to wipe out the collateral people had put up for loans. That's a massive external shockwave.
Exactly. A huge shockwave. And the data clearly shows it hit altcoins way harder than, say, Bitcoin or Ethereum.
Oh.
While the big guys took a hit, the ripple effect on smaller, lower cap assets was absolutely catastrophic. We saw major alts like Solana crash over 40%. Toncoin apparently dropped 80% very briefly. When you have a $20 billion liquidation cascade ripping through the market, tiny low liquidity altcoins like TLOS are uniquely vulnerable. Why? Because unlike the big assets, they just don't have the deep order books to absorb that forced selling pressure. The buyers vanish instantly.
This leads us straight into that brilliant but also, frankly, terrifying concept the sources pointed out, the liquidity mirage. This feels like a really fundamental insight into why so many smaller crypto projects can look okay on paper, right up until the moment crisis hits. The key lesson here, the really critical one, is that market capitalization, which for this base chain TLOS token was reported somewhere between, $13 million and $16 million. That number simply does not equal real usable liquidity.
Not at all.
That market cap figure, it's basically an illusion. It's calculated based on the price of the very last, maybe tiny, trade multiplied by the total token supply.
Yeah.
It gives this false impression of substance, of solidity.
Let's maybe use an analogy to make it crystal clear. Imagine someone owns a house appraised at $16 million. That's the market cap, right? Big number. Sounds impressive.
Okay.
But if that homeowner suddenly needs cash, say $50,000 for an emergency today, they can't just use the house's value. They can only use the actual cash they have accessible, maybe in their bank account, which might only be $10,000. That $10,000, that's the real liquidity.
Ah, I see. The usable cash versus the paper value.
Exactly. The TLOS token on base chain is like that house with a huge appraisal but an almost empty bank account. It masks these incredibly thin order books. So when that October liquidation wave forced someone, maybe a leveraged trader, to sell even a moderate amount of TLOS, let's say just $50,000 worth, there weren't $50,000 worth of buyers sitting there ready at 0.032 cents. The price immediately had to slide down. 0.031, 0.037, 0.3029 cents. Searching for buyers at lower and lower levels until that $50,000 sell order was filled. That's why you get those terrifying downside wicks, and that's why the price movement is so jumpy and erratic. The market basically has no shock absorbers. It can't handle any real stress.
That distinction between market cap and actual usable liquidity,
Yeah.
that is just so vital for anyone looking at these low cap tokens. Okay, so we've seen the external shocks and the liquidity illusion. Now let's pivot. Let's talk about what the sources identified as the internal structural weaknesses. These seem to be the root causes of the persistent to long-term decline, not just the sudden crashes.
Right, so we've established the storm raging outside. Now let's look at why the ship itself, the TLOS project on base, might have already been taking on water. One of the biggest red flags, honestly, is this fundamental struggle they seem to have with utility and organic adoption. And we're not just guessing here. The TLOS Foundation itself basically admitted this problem in their own published research and documents. They acknowledged that ecosystems that rely too much on temporary incentives, things like massive staking rewards or constant token emissions, just to get people to use the platform, they don't build lasting demand.
They admitted that themselves.
They did. They put out this strikingly candid, quite self-aware quote in their documentation, something like, "When incentives are misaligned and demand is artificial, trust inevitably breaks down." That's the team, essentially, recognizing that they've struggled to find genuine, real-world use cases that naturally make people want or need the TLOS token. And that leads to this kind of ecosystem built on, well, almost like debt. People are only participating to get the manufactured rewards, not because the network itself provides indispensable utility.
That's powerful. The network is basically paying for its own activity, which, yeah, sounds completely unsustainable long term. But maybe the most concrete structural risk for anyone holding this token right now is this issue around potential token supply inflation, specifically this governance proposal known as TED-P4.
Ah, yes, TED-P4. This is a major internal concern, and it likely acts as a huge wet blanket, actively suppressing any chance of meaningful price growth. The TED-P4 initiative, it proposes adding another 65 million TLOS tokens to the total circulating supply.
65 million more tokens.
65 million. That's a massive potential injection of supply, especially when you consider the already super low liquidity we just talked about. And crucially, the release of these new tokens isn't immediate. It's subject to what they call price-gated unlocks. These are basically pre-programmed price thresholds. If the TLOS price manages to hit certain levels, riddle 25 census and 75 cents, then chunks of this new supply get released onto the market.
Okay, hold on. Here's where it gets really interesting, right? Because the market psychology just takes over. The price right now is scraping along at 0.32 cents. So obviously, none of those 65 million tokens have been unlocked or released yet. But the mere existence of this pending dilution, this guaranteed future supply shock hanging over the market, it acts as this psychological and frankly quantitative hard ceiling on the price.
Exactly. It's a ceiling.
Think about it from the perspective of an informed investor, maybe an institution or a whale. Why would they risk committing significant capital, say millions of dollars, to try and push the price up from 0.03 cents towards 0.25 cents? Knowing that the second they succeed, they automatically trigger this massive flood of new supply from the project itself. That new supply will immediately push the price back down and dilute their own holdings. This mechanism basically punishes success with guaranteed selling pressure.
You've nailed it. It's a self-imposed price cap. It sends a clear message to any sophisticated buyer. Sure, try and push the price up, but we guarantee you'll be met with heavy selling the moment you get close to these levels. It just completely chokes off recovery attempts before they can even gain any real momentum.
It seems designed to prevent recovery almost.
Well, perhaps designed to manage inflation or fund development upon success, but the effect in this market context is suppression. And this combination of structural flaws and these market mechanics, it creates this really vicious cycle. This is what drives the consistent falling of the price we were asked about. We can actually break this mechanism down. It's like a repeatable 5-step downward spiral that feeds on itself. Step 1 is the initial weakness. Those underlying challenges in creating real organic demand and utility, which the foundation even admitted to. This creates that low liquidity environment to begin with.
Okay, starts weak.
Step 2 is the leverage cascade. When the broader market takes a dive, TLOS, being a low-cap altcoin, sees leveraged holders getting liquidated. This forced selling hits the thin order books and drives the price down violently.
The external shock hits the weak foundation.
Precisely. Step 3 is the liquidity exodus. As the price keeps falling and everyone sees how thin the liquidity really is, traders get more and more convinced the asset is, well, toxic. They rush for the exits, creating this persistent, ingrained selling pressure. The psychological need for anyone still holding to get out before the next drop becomes overwhelming.
Panic sets in.
Step 4 is supply concerns. That looming threat of the 65 million new tokens acts as that rigid ceiling we discussed. It ensures even temporary bounces are capped, making the asset deeply unattractive for anyone looking for growth.
No point buying if there's a guaranteed seller waiting.
Exactly. And finally, step 5 is the narrative breakdown. Without any compelling positive news or clear signs of successful execution on those big long-term visions, every recovery attempt just fizzles out. This reinforces the negative feedback loop. The cycle confirms the problem isn't just bad luck, it's deeply structural.
Okay, that paints a pretty grim picture of the internal mechanics.
Yeah.
Now, we absolutely have to move to the core of the listener's question about legitimacy,
Correct.
the integrity of the actual contract for this TLOS on base chain. Because the sources flag something really fundamental here, this confusing mess of multiple TLOS tokens existing. We need to be super clear here. The main official TLOS token that lives on the native TLOS blockchain.
Right. And there are official wrapped versions that let it work on other chains like Ethereum and BSC.
Correct. Those are generally understood and tracked.
Okay. But the specific token we're dissecting today, TLOS on the base chain, this one appears to be something different. Maybe a secondary asset, or potentially, and this is worrying, an entirely unofficial clone or replica. Yeah, the implications of this multi-token environment, especially for this specific base chain version, are huge. And frankly, quite negative. The metrics we could find for this base chain token are, well, they're pretty abysmal. Its market cap jumps around wildly depending on where you look, anywhere from a tiny $260,000 up to that $16 million figure, which itself suggests data inconsistency. And the holder count seems minimal. One source mentioned only 814 holders for the Ethereum version, which strongly suggests the base chain activity is similarly, if not even more, sparse.
Wow, only 814 holders. That's tiny.
It's incredibly small for a token with a supposed multi-million-dollar market cap. This low adoption rate, combined with the fragmented market presence, points towards two really dangerous possibilities. First, it's quite possible this base chain version is just a community-created replica or clone token, something the official TLOS Foundation hasn't actually sanctioned, audited, or supported. And second, even if it has some loose connection, there's just overwhelming damaging confusion in the market. You might have investors out there thinking they're buying into the main official TLOS ecosystem, but they're unknowingly putting their money into this low liquidity derivative on base. This scatters capital, attention, and trust away from the potentially more legitimate core asset.
That distinction is absolutely critical. It's like buying shares in Coca-Cola Bottling Anytown versus buying actual KO stock. The base chain version might be more like the former sort of unvetted, potentially risky side project with minimal oversight compared to the main thing. Okay, but what about the contract integrity itself for this specific base deployment? Did the sources find any concrete honeypot signs where you literally can't sell?
The available data didn't definitively confirm classic honeypot indicators, where selling is completely blocked by the contract code. However, tokens that show this exact profile, extreme price destruction, minimal liquidity, and this kind of confusing market identity, they very often share a set of common vulnerabilities, even without a hard honeypot. What kinds of vulnerabilities are we talking about? Well, typically you see a critical lack of proper independent security audits for that specific base chain contract deployment, or a lack of clear formal community governance around it. Furthermore, you often find extremely high slippage when trying to trade it on decentralized exchanges. Slippage means the price you get when you sell is much worse than the price you saw just before you click swap. High slippage on even moderate sell orders essentially makes exiting very difficult and costly. It acts like a soft barrier to selling, even if the contract doesn't explicitly forbid it.
So it's not technically a trap, but practically it's very hard to get out without taking a massive hit.
That's often the case, yes. And another huge risk factor with these kinds of low-cap, confusing tokens is concentrated ownership.
Ah, the risk of the founders or early whales dumping.
Precisely. You often see the potential for the deployer of the contract, or just a handful of early buyers, to control a massive percentage of the total supply. If only a few wallets hold, say, 50% or more of the tokens, those wallets can completely manipulate the price or just decide to dump their holdings all at once, causing the kind of rapid crashes we've seen with TLOS on base. And the lack of transparent token distribution data for this specific base chain deployment means regular investors can't easily check who holds the power. All these factors together contribute to that consistent selling pressure, because anyone who can get out and understands these risks probably chooses to do so quickly.
Okay, that really covers the contract and legitimacy concerns. It sounds like, at best, it's confusing and high risk, and at worst, potentially problematic structurally. This brings us squarely back to accountability. Is the core TLOS team responsible for this consistent price collapse? The source materials seem to land on a nuanced answer, rating their responsibility as just moderate. Honestly, I have to push back on that a little, based on everything we've just discussed. If the foundation itself acknowledges fundamental tokenomic flaws, if they oversaw plans that could lead to massive dilution, if they admit struggling with organic adoption, why only moderate responsibility? Doesn't that sound like the very definition of poor strategic decisions and governance failures driving the price down?
That's a really fair challenge, and it's important to clarify the reasoning from the sources. The moderate rating seems to stem from two main points. First, the data clearly shows they aren't solely responsible. That massive external market cascade on October 10th played a huge, undeniable role in the immediate crash, regardless of TLOS's internal issues.
Okay, the macro context was brutal.
Brutal. And second, the sources seem to give them some credit, perhaps, for actively engaging in internal reforms and, quite rare in this space, openly acknowledging past mistakes in their own publications. Now, the team is certainly not blameless. Strategic errors were made, absolutely. Overly ambitious emission plans, the struggle to generate real utility, those are on them. However, the material also highlights their ongoing efforts to fix things. Remember, they brought in a new CEO, John Lillick, in late 2024.
Right, with the big vision stuff.
Yeah, he outlined this ambitious, forward-looking vision, the TLOS exchange partnership, the TLOS Zero Layer Zero infrastructure project, aiming to compete at a really fundamental level in the blockchain space. And this is the critical analytical gap the sources point to. These are all very grand, very long-term plans. The market right now is inherently skeptical, especially about altcoins. These big ideas haven't translated into any meaningful price support for the current TLOS token holders, especially not this base chain variant. The market is basically saying, okay, nice vision, but we're skeptical you can execute it, and more importantly, those plans don't solve the immediate problems of low liquidity, potential dilution, and questionable utility right now. The relentless price decline suggests investors just don't see how these long-term plans benefit the TLOS token itself in the near term.
So the strategy might sound good on paper, but the execution timeline or the market's perception of its relevance is just completely disconnected from the current structural decay. That makes more sense. We also have to circle back to that really striking moment of self-awareness in their September 2025 paper, Toward Ultrasound Money. The TLOS Foundation flat out conceded fundamental tokenomic flaws. They admitted that relying on token inflation just forces networks to manufacture artificial activity. They even said trust simply can't thrive in these high inflation systems. I mean, that's the team itself saying the foundation of their token has been shaky, which directly fuels the chronic lack of real demand we're seeing play out.
It's quite remarkable candor, really. And if the foundation is admitting such deep systemic flaws, what's the community reaction? Well, the research suggests the overwhelming response is silence, which in the crypto world is perhaps the most damning indictment of all. Our searches for active, vibrant discussions about TLOS, specifically in places like Discord or Telegram communities, turned up very minimal engagement. It seems pretty quiet.
So, no passionate defenders or active builders buzzing.
Not much visible, at least not easily found or widespread for this specific context. This lack of visible, vibrant community discourse, development chatter, and marketing buzz. It strongly suggests the community has largely lost confidence and simply moved on. In crypto, as you know, momentum, narrative, and community energy are almost everything. When the price is constantly falling and the community goes quiet, it just pours fuel on the fire. It removes any potential source of organic buying pressure or belief needed to counteract the structural selling.
That lack of community buzz basically removes the only force, besides maybe pure speculation, that could potentially lift the price based on belief or future potential. And that takes us neatly to our final accountability buckets, the external forces, where the sources rated responsibility as high. We're talking here about market mechanics that are largely independent of whatever the TLOS management did or didn't do, right? The broader crypto market structure itself bears significant blame for the decline.
Absolutely. We really can't overlook the systemic issues here. Things like the excessive leverage that just permeates the entire crypto landscape. That's what causes those devastating cascading liquidations across all altcoins whenever there's an external shock. That's a macro market structure problem, not specific to TLOS, although TLOS was clearly vulnerable to it. And we have to hammer home again that point about structural integrity or lack thereof for low cap assets. It gets hidden during bull runs when everything's going up, but it gets brutally exposed during downturns. That thin liquidity we keep coming back to, it becomes an absolutely lethal vulnerability when serious selling pressure starts. The geopolitical shocks, like those tariff announcements, they were just the trigger. They exposed the pre-existing condition of fragility within TLOS on Base and many similar assets.
So the trigger wasn't the root cause, just the thing that revealed the underlying weakness.
Precisely. And finally, there's that undeniable factor of the investor risk appetite shift, which the sources also rated as a high responsibility factor. The market over the past year or so has systematically rotated away from highly speculative, low utility, low liquidity assets like this seems to be. Investors are clearly favoring more established assets, things with perceived stability, or projects with genuinely demonstrated utility. TLOS on base, unfortunately, fits the profile of exactly the kind of asset that this current market cycle is punishing the hardest, leading to that disproportionately severe selling pressure compared to Bitcoin or Ethereum.
Okay, so wrapping this all together, what does this actually mean for the TLOS token on the base chain? Specifically for you, the listener, who might be holding it, or maybe less likely now, thinking about investing. It really means the token seems trapped in a perfect storm. On one side, you get these huge external systemic market forces, volatility, leverage, liquidations. On the other side, you have these self-inflicted wounds, structural tokenomic flaws the foundation admits to, minimal organic adoption, and this really concerning, potentially fatal uncertainty around the contract's legitimacy and the confusing market position of the base chain token versus the native one.
Yeah, and our deep dive into that spectacular but fleeting October 31st flash spike, it just confirms it was purely a technical liquidity-driven event. Probably a short squeeze or maybe trap sellers getting liquidated upwards briefly. It was not a sign of returning fundamental health. The fact that the price couldn't hold those gains for even a few minutes just confirms that the deep underlying structural issues are what's really driving the narrative here, not any temporary market blip.
So the final verdict.
The conclusion for investors has to be one of extreme caution. Based on our thorough review of the source material, this token, TLOS on base chain, exhibits all the classic dangerous characteristics of a low-quality, highly speculative asset. You've got critically low liquidity leading to massive, unpredictable volatility. You have weak fundamental utility that seems reliant on manufactured activity. And you have this deeply confusing market positioning because of the multi-token environment and questions about its official status. For a price to fall so consistently, you need consistent negative pressure, and TLOS on base seems to be getting that pressure from its own structure, its fading community, and the unforgiving macro market.
That is a stark but comprehensive assessment. Exactly what this deep dive needed to uncover for you, our listener. Now, building on this core idea that TLOS's primary weakness might be its structural reliance on manufactured incentives and that terrifying liquidity mirage where market cap means almost nothing in a crisis, I want to leave you with one final provocative thought to chew on. How many other seemingly stable, low-liquidity altcoins lurking in the vast crypto ecosystem right now are masking a similar fundamental structural vulnerability? How many are operating on tissue paper-thin order books, just waiting for the next major geopolitical event, the next regulatory shock, the next market cascade, to reveal their own true, almost non-existent depth? Thanks for diving deep with us today. We'll see you next time.